On our multi-asset solutions team, we actually just had a discussion about this earlier about the higher likelihood of this tipping into something a little bit more dramatic. It seems like, the central banks are trying their best to extend the economic expansion. But the fact is, what ails the economy, both in the U.S. and globally, to the extent you can say something's ailing the U.S. economy, I mean, it is pretty healthy, is really outside of the control of the central bankers. It's really a political decision on the trade talks. Is it going to extend the economic expansion, or is it going to extinguish it? And I think that investors have gotten a little exhausted from all the back and forth and just want some resolution. And our team believes that there's a high likelihood that if things even have a hint of falling apart after, say, Thursday's discussion between the U.S. and China, that could signal a further leg down with U.S. equity markets here. And so we're positioning our portfolios quite a bit more defensively.
But what's a leg down? I mean, it seems like the disappointment would have to be pretty extreme to get you down more than 5%?
Well, right now we're about like 3.5%, 4% off of the previous high. If we break through the 200-day moving average, then we do think that it could really push us into what could be considered more of a correction territory. So, if it's a 5% leg lower, 5% can snowball because of the adverse effects that it has on sentiment.
Beata, do you agree with that? Are you taking or recommending a more defensive posture with this market right now, or do you see it differently?
Well, coming back to the growth problems and the scarcity of growth, we think that in the late cycle, where we are right now, it's absolutely natural that the growth is getting scarcer, and actually the market is starting to chase and bid up for the places in the market that are still providing growth. So for us, that means volatility should remain high, but also it means that we have a big tilt of preference for growth over value. In terms of cyclicality and defensiveness, we are more on neutral stance in terms of sector allocation.
Hey, Beata, you said, I think 4 of your checklists on your dashboard are suggesting an end to the global bull market. You said you'd need to see the red flag count go to double digits before thinking that the next dip should not be bought. Which flag do you think is poised to flip next?
Well, so out of the 18, as you said, out of 18 factors that we have in the checklist, there are only 4 that are flashing red. Back in the previous cycle's peak, we had 13.5 and 17.5 in 2001. Probably we won't get to as high numbers as in the previous cycles, but we'll be looking more into 7, 8 red flags before we start getting really worried. But of course, some of the parts of the checklist are suggesting caution, and the one I would flag is the inversion of the U.S. yield curve. So that on its own is quite worrying. It tells us to be worried about the prospect for growth over the next 12 to 18 months, but it doesn't tell us to panic straight away.